I would start with them, because firms have mandates of how much they have to invest, right? So like for us, if we're given $20 million, we have to tell people how many companies that's going to be stretched across. And the problem is that sets a very consistent number. But as you know, that number is the number that you're raising is dependent completely individually on your company and where your company's at. So it almost puts you in this weird situation of where the investor is trying to tell you how much you need to raise, so that you can fit their mandate. Sometimes you kind of have to do that, but I would advise against it. So to figure out how much you should raise and how to find that person that raises that, it's always a lot easier to get someone to stretch up a little bit than to push down a little bit. But the other thing that you can do is you can go to these VCs and you say, okay, well, here's what we can do. So we need 350,000, but what we'll do is we'll say, if you give us 350,000 now, we'll give you the option to buy shares at a 50% discount as well to the, whatever the round after that is. And that gives you the option to put money in later if we succeed on the benchmarks that we'll set out for this. So then, yeah, so then they set, their goal of, okay, we need to deploy this much money into a company. And then you're also taking the risk off their hands of saying, well, instead of giving us all this money up front and taking the risk on us now, give us a smaller amount. We still give you preferential rights to buy shares at a cheaper price in the future. And then you kind of both are aligned on that direction. So that's one way to go about that.
I see. So you're almost saying like, just do like a convertible debt round or like a safe note or whatever with it.
Yeah, kind of like, think of it as like, if you're raising on a safe, you could do the main safe, and then you can give them something called a side letter, where you can kind of negotiate like, okay, this will all convert at our, say, seed round, right? But we'll also give you, if you reserve up to 1 million for us, we'll have that convert prior to the Series A as well. So then you're giving them kind of a little bit of a sweeter deal. And the nice part is that by doing things like this, you can actually pre-plan your capital much longer, which means that you don't have to go out and constantly be raising every 12 months. If you know that you've signed someone for saying 300, a chunk of 300, and then if we hit this benchmark, another chunk of 300, and then this benchmark, another chunk.
Interesting.
And you can actually just build your company rather than talking to idiots like me all day.
Not even. You said that was called a side letter?
Yeah, so side letter is usually, it's terms that are outside of the safe note that are like extra terms.
Gotcha. Mm-hmm. Awesome. All right, thanks.
That's the best advice I heard all week.
Yes. So, yeah, Pat, go ahead. Sorry.
Yeah. So on a similar note, so you mentioned about a few red flags that you see in founders, especially when they're talking about fixed, knowing what the market size is. Can you elaborate on that?
Yeah. So I'll give you a good example and a bad example, right? And I'll try and make it specific to your guys' company. So a bad example would be, if I were to ask you, okay, so what's your understanding of the market size for your product? And you say, well, this is huge. There's tons of people who have these disabilities all over the world. Very bad answer. A good answer would be, well, there are X number of people with this disability, and this disability globally. There are X number of those people in the United States. We believe that we can reach X% of those people. Right. So that shows that you're not just lazily saying, okay, well, there's a huge market out there, we'll go after a huge market. It shows that you're deeply thinking about the size of your market, the customer, and what percentage of that customer you might be able to go after. And the reason, so nobody really cares about the answer to that specific question. What we're really trying to do with that question is see, okay, how do the founders think about understanding the metrics of the market? Because if you do that level of analysis with that question, most likely you're going to think at that level of analysis for all of the other type of market gauging questions that you're going to have. And then the same thing goes for hiring. And then the same thing goes for product development. So it's our way of trying to understand, how do you as a founder think? And is that going to be replicated into the other areas of building your company?
Got it. Thanks. So
yeah.
I heard that if someone says that this is the market size that is fixed, so I might have misunderstood it, but do you think that's a bad thing or a good thing?
No, I think it's about how you define it, right? Because if we go back to the example of Spotify, if they were going to say what their market is, their current market cap is larger now than the entire record sales figures were when they were founded. So there are cases of where you're taking one market and you're evolving it into a completely different type of market dynamic. But it's just showing that you can quantifiably understand what the current market size is and what percentage of the customer you're going after, right? So then in your case, you would say, okay, well, here's the whole size of the market. And then here is the size of it that's between this and this age, which we feel will be more receptive to our product. Or this is the percentage of them who already wear prescription eyewear, right? So if you take the average amount of people in the United States who wear prescription eyewear, and then you overlay that same percentage over the market of people who might have a disability that you guys are attacking, then it shows that, okay, they've thought about it to a degree of where they're not going to try and convince people to wear eyewear that don't already wear eyewear. They're just going to replace the eyewear that already exists. See, it's again showing that you're thinking about problems to a much greater degree than just, oh, I'll put my product out and people will use it.
Got it. Understood. Thanks.
So the way that we began this whole conversation with you is you asked for our little 30-second pitch. What is the best way to approach that in your opinion? Seems like you have pretty strong opinions about these things. So
yeah, I do. The thing is that I understand where the value of pitching came from. Really what it was is it's a way to streamline the data collection process for an investor, right? So if you have everybody pitching on the same kind of format, it makes it very easy to quickly understand what people are doing. But would I want to invest basically off of a pitch? Absolutely not. In fact, I would just erase pitches in general and just want to talk to the founders about what they're doing and how they understand their companies in depth. But in terms of if you're going to quickly introduce what you do, 30 seconds, yours was perfect. You're the social media for news. Maybe you would add in like what that interaction is. So we are the social media for news where people see X based on Y. And then if you have a little bit more time than that, you try to say that here is the problem, even though a lot of big tech companies aren't really a solution to a problem. They're just iteration on efficiency. But you would say, here's the thing that we are doing because of our experience with X, and here is why we think it's valuable to Y person.
Okay, great. Thanks so much.
Yeah. But yeah, in general, pitching for me is, again, just a lazy way of collecting information. So I understand its value, but I will never invest based off of a pitch.
Yeah, I really appreciate your whole transparency and like your investment thesis and everything. We meet with some VCs sometimes and like, yeah, we invest in this vertical, and then we look at their portfolio and it's like, that doesn't really seem like it. Yeah, I really appreciate you being so transparent and straightforward with everything so far. Yeah, why do you think that is? Like, why do you think most VCs don't just meet with people for like a 5-minute phone call of some sort? Like, why do they want such structured things going on? Like, what's up with that? Like, what's the lack of transparency?
Because it's easier. Right? Because it's easier. So if you're going to see, like, go back to my case of when I was at Cap A, if we're going to look at 3,000 pitches a year, then you condense that down into how much time I can spend on each pitch, whereby, okay, if everyone is exactly in the same format, then it's just a factory line. I'm just looking market size, how much they're raising, team, headshots, logos from the companies. Are they good? Yes, no, pass. Right. And they're seeing it as a function of trying to look through as much deal flow as possible. The newer generation of venture investors, I believe, have a deeper understanding of that venture is a function of access rather than selection. So it's not about how smart I am as picking companies. It's about having access to the best companies. And so if you dedicate more time to understanding the founders, most likely you're going to have more outsized returns, because you'll be able to pick a Mark Zuckerberg when you don't really understand exactly what Facebook is doing at that moment in time, but you understand that he is an exceptional leader, kind of, and that they had a product that was incredibly viral. So that's what I believe. I think once you start to meet investors who are much younger or who have worked in very competitive ecosystems, they understand this kind of stuff. But for others, I would just say, it's easier. It's easier to do it that way.
Interesting. And just real quick, what's your current opinion on like the fundraising landscape as of like right now? I see a lot of VCs just throwing a ton of money at different people. What do you think about that?
Yeah. Low interest rates do incredible things in private markets, don't they? It's a function of two things, right? So a lot of this started from, well, we have to look at that tech as democratized outside of an asset class, and it's now just a function of everything, right? So someone doesn't say that they're going to invest in an accounting department. Every company just has to have it. And tech is moving from something that was a very specific vertical to something that a lot of companies had to address to now becoming a core basis of how every company has to operate. And with that, it obviously becomes a much larger and larger and larger market size. So if you look at, you could parallel it to what has happened in biotech, for example, of whereby, the average biotech seed round now is like $50 million. And that's because the market that you're going after is so large, and the amount of capital that it takes to be competitive in something that's really large is huge. But then the other side of it is that a lot of funds have raised money, and that forces you to then invest that money. And you have to remember that a lot of investors get paid a 2% management fee every year to manage the money that they have. So then they can get a little bit of an ego association with how much they have under management, right? So if you manage 40 million in your first fund, then you're going to say, oh, well, okay, if I go out and raise a fund for 100 million or 200 million, the amount I get paid every month is way higher, and that's way cooler. Or, oh, look, I'm raising the big fund, and they don't do as well of an analysis of what the market actually can require. So that's where you start to see where, well, I've raised 200 million, I need to deploy that into 10 companies. So I have to give $20 million to a company. Just like the Malcolm's previous question of where VCs are saying, oh, well, we can only put 500 into your company. It's not an analysis of what the company actually needs. It's trying to get the company to fit the mandate based on what they've raised. So I think we're going to have a pretty big shift in the way that investing is done, whereby the time horizon will change so it doesn't force companies to move crazy fast, whereby they can actually kind of become enduring businesses. And I think there'll be a change in the way that capital is structured so that it can be more aligned with what the company needs rather than some artificial mandate that a bunch of people made up in a room.
Is it a red flag to you if a founder is raising money mostly for like growth? Like I told you, like I think half our money will probably be used for like hosting influencer events or like building out a bit of like a sales team. Like we're kind of good on the dev side for the most part. Some people tell me that that's like a red flag, that it should just all be on product.
No, because then you would totally miss out on a sales force, right? Like Salesforce's growth was almost entirely based upon having an incredibly effective sales team. A local company here, KnowBe4, who just IPO'd, I mean, they don't really make a revolutionary product. It's more so that they have a rock star enterprise sales team. So it depends on what you're doing, and it depends on the level of product market fit that you have. So if your product is fairly simple and it's already revolutionary in its own right, and you can prove that you have, a low churn rate of customers, and you've kind of already hit that point, then that's really what most of funding is just to acquire customers. And that's fine. But at the early stages, if you're raising money to go after growth, but the product isn't really to a point of where it can support that broad scope of customers, that's where it can be a problem. So I think that's more of an opinion thing. That's definitely not a law of truth.
Okay, helpful.
Andreas, what kind of investor should an early stage company go for when we are still figuring out the fit, like how the entry in the market is, where investors contacts, their networks, their experience? So how is firm versus angel involvement? Like what investors can offer founders in early stages?
Right. So if I were to rank them in order, I would say a firm is number one, like a dedicated VC firm, right? So in your guys' case, like a firm that you know has invested in hardware, because it means that they have the experience with your business model, so they won't freak out whenever, you know, like a supplier provides a bunch of RAM chips that aren't functional, or there's some sort of, you know, supply chain issue. So they understand your business model and they've invested in it before. And the reason why I say a firm first is because VC firms are able to collect, to use their management fees and collective capital to provide basically resources to you, versus an angel investor doesn't, as well as they're managing other people's money. So they have a mandate to do so. So the better the firm you can get, that's like number one. Number two would be an angel investor, but someone who's a very active angel investor in the way that they can help you, right? So if you go on their Crunchbase profile and they have like 500 investments, they're never going to help you with anything. They're just a source of money. So they kind of drop down on the list. An investor who is going to be able to open doors for you, be able to introduce you to potential hires, introduce you to potential manufacturers or customers, whatever it may be, that's like number one. Like if I were, when I was sitting in the role of CFO and trying to figure out who should we take money from, I would gladly take a little worse terms from an investor that would do much more for our business than take much better terms from someone who is just a source of capital. So I would rank it there, right? It's like a XY balance of how helpful they can be in your business versus how efficient and productive their terms are. And as well as you want someone who can close very quickly. So that's almost one of the first questions I would ask is, what is your process for doing due diligence, and how quickly do you close after saying yes? And if someone says, well, I don't really know, or they're not willing to put something in their terms to kind of put a restriction on that, then they fall down the list. Because you want to, again, that fundraising is a necessary evil, but it's not building your company. It's just acquiring a tool. Like if you had to spend 6 months to get a loan for a house, if you were a real estate investor, that would be insane. So spending 6 months fundraising at the early stage is kind of the same thing.
And when, apart from money, from investment, when do you think is a good time for a company to go to a firm or investor for the connection in the industry to fasten up their market process, basically?
Yeah, you'd at least have to have a functional product, unless you've been, you know, a founder who's had success before. And I hate that's a thing, but it is. You really have to have a functional product, and at least the way you can kind of hack customer traction is, because you'll hear that a lot, right? What's your traction? What's your traction? What's your traction? And then you immediately go to sales, and it's kind of confusing, right? Like you don't have the money to finish the product, so you can't just go to sales. But a different way to do that is you can do beta studies with customers, or you can, you know, ways to show customer interest other than revenue still count as traction. So that's one way to do it, is just start to move upstream and show kind of customer interest, customer satisfaction, do mass surveys, have people do beta tests of your product. That's one way to show significant traction for your customer type. So once you've got that kind of stuff, that's probably a good time to go out to the firm, but make sure you research the firm and understand that you're pitching someone who invests in your space and invests at the stage that you're at.
Understood. Yep. Thanks.
Yeah, Andres, one more question. So it's kind of around like how you balance out what your long-term vision is versus where you're at today.
Mm-hmm.
So for us, for instance, we're essentially trying to create a gaming token that's the equivalent of the gold medal at the Olympics. But where we're at today is we're just like a 50-50 video game tournament platform.
Mm-hmm.
And I find it kind of confusing to pitch because it seems like there's a lot of things kind of going on.
Mm-hmm.
So I was wondering if like you had any suggestions on how to approach that a little better, if that makes sense.
Yeah. Do you typically explain when you're pitching, how much of your pitch is a balance between what your company is doing versus what is happening in the market? Or at least your understanding of the market, right? If you're doing something novel.
Sure, that's a good question. So I actually say we focus a lot more like on our products and what we're trying to do, and then we have like a slide and stuff that shows like, you know, total addressable market, serviceable addressable market, all that stuff.
Right.
But yeah, I'd say it's mostly focused on what we're trying to do.
So that would be something that I would potentially adjust at the early stage, because the thing is if you're explaining what you're trying to do, the vast majority of investors are not going to be core experts in exactly what you do. Like, unless it's an angel who built an esports company or a mobile gaming company before, or something like that. You're just another vertical coming into their door, and they're just instantly analyzing that. So what I would do is I would do slide 1 intro, slide 2, if you're pitching in person, slide 2 is just the quick, here's what we're doing. So you introduce the idea. Slide 3, 4, and 5, I would have focus on market. Start on macro, right? Here is what's happening overall in gaming. Here's overall what's happening in esports. And then you start to drill down to your solution so that it's a story for the investor from, here's the inevitability of the world that supports what we're doing. And then this is how we arrived at, this is the solution of it.
Gotcha. That's super helpful. Yeah, I can make another slide on that for sure. Thanks.
What if like your like phase 1 is just totally different? Like kind of on that note, what you're going to build versus what you're doing now. Like your phase, like our phase 1 is like virtual events, and then we eventually want it to be a social network. And I feel like it's like too much like mental strain on the investor when you're like, you have 30 seconds to explain what your product is, and you explain like you know what I mean? All these different things. How do you balance those two things? Because I want them to be excited.
In terms of the long-term vision versus the immediate product to market. Okay. I would still go backwards. I would still go backwards, right? Because investors are investing in what the potential exit is, and the exit is of your long-term value. So then I would say our long-term vision is to develop a social network based upon one-to-one interactions from digital events. The way that we create the social network is by doing this, and then you boil down to what the actual product is right away. That's what I would do, right? And again, it is very personal, right? So some investors that might not work on, but overall, showing what the long-term vision is what the investor is like, okay, this is what I'm investing in. And then we're going to get down to what the initial product is, which is the leverage machine, which gets us to there.
Okay. And what about like talking about traction, which is only relevant to like the first phase of the operation?
Mm-hmm.
How relevant is it even to talk about traction, given that like it probably has nothing to do with where we're going to end up? If that makes sense.
Yeah, it depends on the investor, and it depends on how much they're weighting that current what you're doing, the leverage machine that gets you to your ultimate vision versus their understanding of the ultimate vision. At the end of the day, traction is what is going to support the company to continue growing on a capital efficient basis. So most investors aren't stupid. If you're building something that doesn't generate enough traction to support itself, then it's very difficult for them to either A, see an exit on their money, or B, not be diluted down to nothing because your company is capital inefficient. So yeah, I would refer back to my earlier comment on traction, whereby even if it's not there in revenue, just start to try to go upstream and show that there is, customer stickiness, or that there's, high levels of growth, or that there's something unique, right? A unique metric to the way that you're acquiring and keeping customers, or the customer experience.
That's helpful.
Just quickly want to add to that. I think it would be interesting to look at Mark Zuckerberg in the early days and what he was doing with Facebook, because he wasn't pitching a vision of getting this platform with billions of people on it. It was a college social network, and he just had a bunch of kids at Harvard on it. So I'm sure, you might be able to get some good lessons from that in regards to the pitch. Exactly.
Because in that case, right, the value of the platform doesn't really exist until there's a pretty big user base. So what the very early, the Peter Thiel stage investor was investing in at Facebook would have been that there was something incredibly viral about the growth of the product. Now, you may not have that viral growth, but you'll have some other metric that speaks to why it's a very unique experience for a customer, and how there's something unique to what the customer is doing on your product. Whether it be dwell time, whether it be number of interactions, right? So in your case, like if the number of interactions that a customer or that a user has from event 1 to event 2 to event 3 is growing by 10x each time, like the number of breakouts, let's say, like the number of one-on-ones they're having, if it's growing by 10x every time, that's really interesting, right? So rather than saying this is the total number of users we have, it's like, okay, the users that we do have are increasing their engagement with our with this feature by 10x over time. And unless you're building something that totally sucks, there will be something that's doing that, right? That's like has an order of magnitude improvement or is growing really fast over time, or, you know, they're spending more time on it, whatever it may be. That's what you're really looking for.
For sure. That's helpful. Yeah, I think for us, it's like how long they're on.
Yeah. Dwell time. It could be a good one. But again, your data is going to tell you what that is.
Yeah.
You can go looking for it, but at the end of the day, your data is going to tell you what it is.
Fair enough.
We have time for maybe 1 or 2 more questions.
How do we reach you if we want to contact you?
Yeah, you can reach me. I guess I'll send my email to Pablo, and then he can distribute that to you guys. You can also, I think my Twitter should be open for DMs. It's just Andreas Calabrese on there. Any other format, right? I'm not a picky investor to where I'm too elite for everybody to pitch me. So
yeah, that's a good question. So I just recently cold DM'd Gary Tan on Instagram. So like, what is the best way to like cold message these VCs, especially on like a social platform? It's supposed to be like more casual kind of a thing. Like, what do you expect? Like, what's not weird to you, you know?
Here's the problem is that there's a lot of, when you look back at your data, or a lot of top tier VCs, when they look back at their data, the cold pitches that they do invest in tend to underperform network introductions. So like in our deal flow system and many others, you would track where the intro to the company came from, whether it was a cold introduction or an introduction through somebody else. And if it's an introduction through somebody else, they're typically, the results are much better for those companies. So if you want to get into a really good investor, what I would do is I would spend, rather than cold pitching them, go into their portfolio and almost cold pitch the CEOs of their portfolio. Because if you can get one of them to find what you're doing interesting, number one, they'll have a little bit more time for you. Number two, they're a founder, so they'll understand what you're doing probably to a greater degree. And then when you get that warm introduction from them, the chances of you getting more time with the founder is much higher. Plus, it's a higher frequency of send outs. So if you're trying to get into Gary Tan, you're sending one email to him, and it's like totally binary, yes or no. But if you're sending out an introduction to all of the companies in their portfolio, now you just increased the likelihood and you took away that binary chance. So that's what that's how I got some of our pitches for the company that I raised money for.
The warm introductions.
That's brilliant.
Well. Okay. All right. Well, I'm gonna go ahead and do that right after this.
Yeah, no worries. Yeah, it's tough. Cold reach outs are really tough at top firms because you get so many of them. And like I said, pitches are trained down to such a good degree that it's almost impossible to differentiate a good idea from not a good idea, a good team from not a good team. So kind of going in through a back door of their portfolio or their law firm or somewhere like that is actually a much better way to do it.
Great, thanks.
Do we have to be in Tampa for you to invest, or like if we're willing to relocate, is that okay?
Yeah. But I will say that there is a competitive company to you here called Lunch Pool, so check them out.
I will.
They're doing something pretty similar.
Awesome. If we got no other questions, we'll wrap it up here. But thank you so much, Andreas. That was super valuable. Really, really enjoyed hearing some of your insights. And I wish our other founders could have made it because they really missed a good one. But yeah, looking forward to having you at Demo Day and having you interact with some of the companies. And yeah, really appreciate you making the time to do this.
Awesome. Thank you. Yeah, I really appreciated it. And feel free, anybody, to reach out with further questions or any help on demystifying the fundraising process, because this is kind of a weird thing to do. So
if I share your email, the Tampa Bay Ventures one is better. Okay.
Yeah, that's good.
Awesome. All right. Thank you so much. Everybody have a good night.
Thank you.
See you guys Thursday.
All right. Thank you guys. Good luck with your companies.
Thanks.